Ho, ho, ho. It's that time of the year and that time of the week where you get to listen to me. So everybody, please put your hands together for me. The only bull who had a 6,000 price target at the start of 2024. And on today's show, stocks, sentiment, seasonality, alpha. And if you want a quick 2-minute recap of the market, go check out the market online. Link in the comments. Now let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks rose on Monday as small caps rallied, the Dow Jones rallied. Both touched intraday record highs. We're going to talk about small caps on the charts. Very interesting stuff. All of this is amid optimism over President Donald Trump's choice of Scott Bessent for Treasury Secretary. Investors are also looking ahead for a price check in the form of a Federal Reserve favored inflation print, which is PCE. So the market rallying on Trump's picks, but we're also moving towards the PCE print, which is looking favorable, especially when you look at comps. Now, we did see some pretty ugly red in Tesla, down 2.29%, as well as Nvidia, and that meant growth overall. The Nasdaq 100 overall was pretty average today, relatively speaking to the rest of the market. Now, there was some geopolitical news that saw a big impact here on energy as well as industrials, especially the aerospace and defense sectors, but we'll talk about that later. And other than that, and a couple of names here in software, right, it was actually pretty green across the board. We saw the energy sector, the XLK was down slightly, pretty much flat. Utilities up 0.2%, and the worst performing sector was the energy sector. Other than that, right, every sector performed really well, outperforming the SPY, which saw a gain of 0.34% today, but from communications to staples, industrials, financials, healthcare, all up in a very big way. And the best performing sectors, XLY, discretionary, despite Tesla's performance on the day, up 0.99%, very strong returns there. And that was on the back of what we saw with Amazon, materials up 1%, and then real estate, the best performing sector. And that's because we saw yields step down in a very big way. And that had to do with some of the Trump election news today. All in all, though, when you look at large caps, mid caps, small caps, it really was a day for smalls. Small growth, small core, small value outperformed mid caps, and then mid caps outperformed large caps. But we saw equitable gains in every single factor except large growth, which was actually down 0.02%. Again, the Tesla and Nvidia really weighing on the large growth segment, but still a flat day nonetheless. And really, you should have a diversified portfolio across size segments as well as factor segments. And if you do, and you would have seen great gains in today's trade. Now, a lot of it actually had to do with this guy right here. President Donald Trump announced Friday evening that investor Scott Bessent will be his nominee for Treasury Secretary, picking a campaign trail partner and early frontrunner for the job after a long and contentious process. Strategists regard hedge fund manager Scott Bessent, founder of Connecticut-based investment firm Key Square Group, as a safe pair of hands. It is expected that the 62-year-old will push for Trump to consider a softer approach to tariffs, strip back regulation to boost economic growth, and target a reduction in deficit spending. News that Bessent is the top choice for incoming U.S. Treasury Minister has raised the possibility that some Trump trades may be watered down and that this will spur growth across all equity sectors. Something I really like about this guy as well is that he's got like deep ties to Japan, did a lot of work with Japan, their debt issue. He really knows how to manage the monetary and fiscal, and he understands the fiscal situation the US is in and how growth can really help that situation. So great pick by Donald Trump. I really like this guy. I didn't know too much about him. I did some research on him over the weekend. I think he's going to do a fantastic job. And that's why the market was really rallying today. And that's why we actually saw, the mid caps and small caps, they're really going to benefit from a stronger economy. And that's why they saw massive outperformance, relatively speaking, but just generally a bullish day in the equity markets. Now, the big loser today was Nvidia, down 4%, and it failed to participate in the rest of the market. And this is coming off its earnings, great earnings, a double beat, raised guidance, but valuation concerns as well as the rotation trade is seeing this name pull back from its highs. And look, growth stocks, the Nasdaq 100 is really going to be weighed down if this name doesn't perform into the end of the year. Nonetheless, we are seeing the broader market outperform. The JETS ETF looking very strong, and the core demographic for travel, which is a bit higher income, the top 50% quartile, they continue to be in good shape in the form of discretionary spending. And Bank of America data showed that monthly travel spending increased 8% in October on a year-over-year basis. That's why we saw airline stocks, cruise liner stocks up in a very big way today. And I do think they will continue to rally into the end of the year. I think discretionary spending is going to be really robust this holiday season. Now, we did see oil stocks as well as aerospace and defense stocks pull back today. And that's because there's been reports that a ceasefire between Israel and Lebanon have been reached, or Hezbollah, I should say. Axios reported that Israel and Lebanon have agreed to terms of a ceasefire. However, the deal still needs to be finalized, but it can happen within days. And that's why we saw oil pull back. It's just the geopolitical tension easing. And I think that's going to be overall good for stocks, good for rates, good for yields, good for the Trump presidency. And then looking globally, we actually saw a very bullish day. Guys, if you just remove South America, which isn't a very big market, as well as China, right? Equity, we actually saw very bullish momentum across the board. Look at Southeast Asia, very green. India, very green. The Australian market, green, hitting an all-time high yesterday, along with New Zealand. And then we also saw Canada and the US, North America, very green as well. Europe too, just a bullish day across the board, except for a select few countries, but green everywhere. The market's looking really, really strong, technically sound, fundamentally sound, and even on the macro front, things are improving across the globe. And looking technically at breadth, the US market continues to show improvement. We saw a jump in the 5-day moving average as well as the 20-day in pretty much every single sector from last week. This is Friday when it says yesterday. This is today. You can see a huge jump up in all of the averages, small, medium, longer term averages looking very robust. This is what you want to see in a bull market. Now, diving into the charts, guys, equities were very green. The S&P 500, Nasdaq up 0.14%. Small caps was the real outperformer, up 1.52%. Mid caps up 1.45%. So smalls and mids really getting it going. But look at the RSP, just shy of 1%. Things looking very bullish here in the after hours, particularly the Qs as well as the IWM. Very strong performance across the board. I think this is going to continue into the rest of the week. I think the big risk is actually that PCE print. If the PCE comes in hotter than expected, especially the core figure, I think that's going to derail the overall market. However, if that inflation print comes in line, comes better than expected, that's going to just add fuel to the fire. And I do think we go higher. So a lot's going to be dependent on this PCE print. What supported the rally today was yields. Yields and the dollar fell significantly, and that actually had to do with Trump's pick, but also some of the geopolitical tensions we saw. And you can tell geopolitics played a big part in the overall momentum in commodities, because even the dollar was lower and we saw gold lower by a significant amount. Same with silver, same with crude. And that is really telling us there was a lot of geopolitical risk priced in. That's coming off now, especially with a ceasefire. And that's why we're going to see yields move down. And I think that also had to do with Scott Bessent and everything we're seeing. So very positive momentum. I've been saying this for a couple of weeks now. What's going to support the rally in equities into the end of the year is yields and the dollar falling. And this could be the start of what we're seeing. This is a big move in the dollar, in yields. And we could see the DXY go to the 104 area before the end of the year, maybe the 103. That's really going to support equities. That pretty much means you get a net US dollar gain of 3% if this falls to 103%, but that's on a currency neutral or on a FX basis. But there are some risks to this market right now, and I do think we are going to see a little bit of churn into this PCE print. Yes, we had a bullish day, but there definitely was bears at the highs. Look at the S&P 500 right there. Okay, we did see movement down from the highs, and that coincided with the call resistance. It didn't move up, and normally when the call resistance doesn't move up and we hit it, what do we see? We actually see a pullback like we saw in the last couple of weeks right here. The call resistance didn't move up. Now it may move up tomorrow. However, that is a little bit of a risk in this market. And then there's also the risk of the inflation print missing. However, I do think based on what we're seeing in the S&P 500 now, we should continue to see a little bit of digestion and a movement lower up until the PCE print. If PCE comes in line, then stocks should move onward and upward. However, the NASDAQ 100, I think there's a little bit of room to run to the upside before we actually see a little bit of a pullback. And then the Russell 2000, we actually did see the gamma flip, put support and call resistance move up. However, we actually hit the top end of that range, pulled back. That's a pretty big wick. However, very, very strong momentum. If we actually look at the IWM, right, actually go to the ETF, this white line was the previous all-time highs. If we just go to the weekly chart, let's zoom out. That was the all-time highs we made in November 2021. We go back to the daily chart. We did hit an intraday all-time high, as you can see. However, it wasn't a close, and what the street's really looking for is a close. Nonetheless, that is a wick all-time high for the IWM. Very, very strong momentum in small caps, and that's because the fundamentals are there. We're looking at like 45% earnings growth this earnings season, and that is expected to continue throughout every single quarter into 2025 as well as 2026. The earnings picture looks robust for small caps. I think we should see revisions higher with this Trump administration, and small caps continue to outperform. Now for the Russell 2000, if we actually look at our gamma charts, what this is telling us is that we can actually see a little bit of churn unless we continue to move the core resistance higher. And I think, yeah, if we do see a little bit of consolidation like we did today, that was a big wick. We did see sellers come in, but if we see a little bit of consolidation here and then make the next move higher, that would be very, very constructive. Nonetheless, when you look at all of these charts on a technical basis, right, guys, we're pretty much hitting all-time highs in the Russell 2000, yeah, and we're making higher highs, higher lows, all-time highs. Very, very strong momentum. You love to see this. That's another 52-week closing high for the Russell 2000. That is not bearish at all. And pretty much what I'm seeing in the market right now, I think the Russell 2000 is going to continue to move higher. I think we're going to see the zones move higher in the Russell 2000, both the gamma flip and the core resistance. I think we're going to see continued upward momentum in the RSP. I think we're going to see a little bit of outperformance in the NASDAQ 100, especially if NVIDIA participates, and then the S&P 500. And for the S&P 500, I think we're at the top of the range. However, all of this can change if the gamma zones move up. Stocks look technically sound. And when you get pullbacks like this over the next couple of weeks, guys, you want to buy those dips, because from now until the middle of January, it's called the turn of the year trade, and stocks are very, very bullish in that time period. Now, again, I've been telling you this for a while. The places you want to be in is not the Russell 2000. You actually want to be in small cap quality, the CARF ETF, right? Strong performance right here. XSHQ, small cap quality ETF. This is where you want to be. That's an all-time high, closing high. Names that I like. PayPal. I continue to like this name, up 1.15% today, and that's a 52-week closing high, nearly at the $90 level. I was saying buy the stock at the 52 level. We traded sideways for a very long time because it was sort of around this March period when I was buying. We traded sideways for a very long time, and now we're reaping the rewards. Same thing with Paycom Holdings. Paycom was up, 1.87% today. Very strong performance. Now, this was one of my best picks. I sort of like picked this at the right spot. I bought it like right here. I had a couple of days of sideways momentum. Then we went higher. Then we traded sideways. And then after the earnings, we ramped up 30% into the trade. And we actually broke the earnings high. That's very, very bullish. I think we see 250 before the end of the year in this name. And for those of you that have missed the end of year rally and you're looking to get into something that's going to outperform over the next couple of months, I think PEXA Group, ticker PXA, is going to do really, really well. We had a little bit of a slide here based on some news of an acquisition
acquisition. However, that's not going to go through, and I think we're going to see this stock rocket into the end of the year. I think we're going to go retake these 52-week highs before the end of the year. I started buying around this area right here, so things looking really, really good. I think Pexa Group is going to outperform, and if you missed the rally, this is a name you want to be in, as well as Meta. I really do like Meta. Fundamentally, it looks really, really well, and it did return 1% today, and I do think we see new highs for Meta into the end of the year. All in all, guys, you really want to buy equities. Things look very constructive, and we are quite literally in the most bullish time period of the year. And also, we have a shortened trading week this week, guys, so do take that into consideration. We have a lot of volume to get through and not as much days into the end of the year. And that's part of the reason why we have these end of year rallies, because there's simply less trading days to do all of these buybacks, all of the reinvestment for the new year, all of the options expiry, which happen to be the biggest options expiry for the year. That all culminates in this December period. So stocks will move higher into here. Material downside will come in January, mid-January, sort of around that February time period. But until then, hold equities, don't jump in front of this, and just ride the seasonal bullish momentum. And this is Goldman Sachs Sentiment Indicator, which just measures stock positioning across retail, institutional, and foreign investors versus the past 12 months. Pretty much if you're above the zero line, your positioning is bigger than it was 12 months ago. Vice versa, if you're below, what we see is a euphoric rise at the 2.3% range. We haven't seen this type of positioning in over a year, and that just has to do with the Trump trade. Investors love a Donald Trump presidency, and the market is really getting giddy, especially in the sentiment department. If then we look at the fundamentals, things confirm that type of sentiment. 475 companies have reported in the S&P 500. The expectation into earnings season was for a 4.7% growth rate. We got 8.9%. We've nearly doubled the consensus expectations. We've also increased margins versus analyst expectations, as well as revenue. Very, very robust growth. 76% of companies reporting above analyst expectations. The long-term average is 66.9%, and it really goes to show the types of beats we're seeing. And if you simply just remove the energy sector, you're looking at a 6.4% revenue growth rate right here and 11% double-digit growth, nearly 12% in earnings growth for the S&P 500. Very robust figures when you look at this. And to be honest, the sentiment as well as the fundamental picture will propel markets higher into the end of the year, backed up by the seasonals we normally see here in November. This is where we are right now. And what normally happens in this November period is we put in a higher low that probably started towards the end of last week, and then we actually go higher for an average return in November of 1.82%. Guys, the bullish turn of the year, end of the year Santa rallies is just beginning for large caps as well as small caps. In fact, right now in the Russell 2000, this is where we are. This is the Russell 2000 and 1000 seasonal pattern since 1979. End of November, early December time period, we sort of put in a bottom for the most part, and then we actually rocket higher. And then it's normally around the March area where we do tend to see a little bit of volatility in the small cap indices. Now, guys, this is not a crystal ball. However, seasonality allows us to assess the probabilities, and the probabilities are telling us right now that stocks are likely to go higher, backed up by fundamentals, backed up by sentiment, backed up by seasonals, and when you look at the average return path, when we've had a very, very strong year like we have, what normally happens? We see gains into the end of the year. And even in a presidential election year, the only time we actually see selling is sort of right before the inauguration towards the January area. So guys, do expect markets to continue to rally into the end of November, December, and maybe into the middle of January. We can talk about material downside after the inauguration, or sort of the middle of January, sort of the 15th around here. That's when we could look at a dip in the market. Nothing major. I'm thinking a garden variety 10% pullback that could extend to 15%. It'll be a great buying opportunity. However, we'll talk about that when we get there. And right now, the seasonals, the technicals, the fundamentals, and the sentiment is telling us
stocks move higher into the end of the year, you want to hold. You should already be positioned because I've told you guys incessantly for the last 3 months, we are positioning for this end of year rally. And that's exactly what's playing out right now. Stocks were up big last week, not so much the week before that, but the election week, they were up huge as well. And that momentum will continue into the end of the year. And diving into the macro, let's look at the economy. This is the Dallas Fed's weekly economic index, and it's sitting at 2.75%. This is fourth quarter GDP tracking. The economic index sitting at about 2.3%. Very solid stuff when you look at it. Economic expansion looks very robust. And when you look at the consumer, right, real income is also very robust, 2.9%, beating inflation, and real income growth into 2025 is also expected to be very robust. Now, the Fed plans to see the PCE and CPI inflation rates at about 2% at the end of the year. We'll see if that materializes, but real income growth forecasts per Goldman is looking like 2.5% for next year. That's very, very strong, guys. And this is real income growth. This is already adjusted for inflation. This number, very, very good. You want to see that. And that's going to be driven in part by higher wages under Trump administration and partially job growth. Goldman actually forecast about 150,000 net gains in jobs every single month throughout 2025, as you can see right here. However, that is just at the go forward break-even hiring pace. Just to understand what that means, the break-even hiring pace is the amount of jobs the US economy has to add to keep the unemployment rate where it is right now, which is at 4.1%. If we go below this pace, I mean in average over the year, the unemployment rate will rise. If we go above, the unemployment rate will fall. The break-even hiring pace predicted by Goldman is 150,000 jobs, and that is what they see in gains per month in 2025. Now, it's not going to be this linear. There's always volatility, as you can see. However, the average is 150,000. So the consumer is set up to look good in 2025 as long as jobs hold up, but the consumer is flush with cash. Money market fund assets are at all-time highs at 6.5 trillion, a tailwind for credit as the Fed cuts interest rates, and this just keeps ramping higher. And I think until we actually see a 3.5, potentially a 2 handle in the Fed funds, in these money market funds, that's when we'll actually get money deployed into the market. However, Apollo Research think different. They suggest the most likely scenario is that money will leave money market accounts and flow into higher yielding assets such as credit, including investment grade private credit. We'll see if that is the case. However, you can't deny the fact that consumers have access to this cash, and if anything does go wrong in the next year, they do have a huge buffer, along with just the massive wealth effect that they've seen from equities and just investment grade assets in aggregate. Looking at earnings for the rest of the week, guys. Now, a very light week of earnings. We are nearing the end of this Q3 earnings season, and we're going to talk about Q4 earnings in tomorrow's video. But Tuesday, tomorrow before the open, we have Abercrombie Fitch, Kohl's, Best Buy's, Macy's, Dick's Sporting Goods. So a lot of the lower end consumer, mid to lower end consumer stocks are reporting tomorrow before the open. That's going to give us a really great indication as to where the bottom 50% quartile of the consumer stands. And looking at Tuesday, we have a couple of big tech names, especially in the infrastructure space: Autodesk, HP, Workday, CrowdStrike, Dell, all reporting after the bell. So a very big day of earnings tomorrow for Tuesday, but then that's really it for the rest of the week. But we have the big earnings on Tuesday, and then we also have the FOMC minutes. We get core PCE, that's going to be very important, the inflation picture. We also get the durable goods, and then the GDP growth rate quarter over quarter. This is the second revision for the third quarter, and then we also get the personal income outlays, personal income month over month, personal spending month over month. But we'll dive into consensus expectations and forecasts for that in tomorrow's video. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.